Have you ever heard of fair value gaps? If not, you're about to discover a powerful concept that can completely change the way you trade. If you're already familiar, you're in for a treat. I'm about to show you a brand new strategy using fair value gaps that's giving me incredible risk to reward ratios, just like this. And the best part? This strategy actually works most of the time. Let's get straight to the point. Today, I'll show you how this works using euro to US dollar as an example, but you can use this strategy on any market, stocks, crypto, Forex, you name it. Step 1. Identify a key level. The first step is to identify a key support or resistance level, depending on whether you want to go long or short. For this example, we're looking for a short, so we need a strong resistance. You can do this by spotting a recent swing high or by moving to a higher time frame, like the 1-hour chart, and finding a major resistance there. Here, price has just made a recent high, which also lines up with strong resistance on the 1-hour chart. Draw a line on your chart to mark this key resistance. Step 2. Wait for a fakeout. To boost your probability of success, wait for a fakeout. A fakeout happens when price breaks a support or resistance, only to quickly reverse and move in the opposite direction. Why do we want a fakeout? Because when the price fakes out above resistance, lots of traders jump in long, placing their stop losses just below that level. When price snaps back, it triggers those stops, adding fuel to the move down, exactly what we want for a short. So, after marking resistance, watch as price approaches but doesn't break it fully, then it tries again and just barely breaks through before quickly dropping. That's your false breakout. Step 2, done. Step 3, confirm with lower lows. Next, we want confirmation that price is likely heading lower. How? Wait for 2 consecutive lower lows. If price makes 2 lower lows, there's a high probability we're at the start of a bearish trend. Here, price made a false breakout, formed a low, bounced slightly, then made another lower low. This, along with the false breakout at resistance, are strong bearish signals. Step 4, find the fair value gap. Now, you might ask, when do I enter? We find our entry using a fair value gap. A fair value gap occurs when price moves so quickly in one direction that buyers or sellers don't have time to react, creating an imbalance. The market will usually return to this area to fill the gap. To identify it, look for a big move and mark the area from the wick of the candle before the move to the wick after the move. You can also use the fair value gap look-algo indicator in TradingView. Set its value to 2 in settings. It will automatically highlight all fair value gaps on your chart, coloring bullish ones green and bearish ones red. Step 5. Enter at the optimal level on the second lower low. You'll often see a bearish fair value gap. If there are multiple gaps, always pick the highest one for your short entry. You'll get the best risk/reward. I like to use the gunbox tool in TradingView. Set it up like I do, pause and copy the settings if needed, then place it exactly over the fair value gap. This draws a line at the 50% level of the gap. That's your ideal entry. Wait for price to come back and touch that line. When it does, enter your short. Step 6. Set stop loss and take profit. Place your stop loss at the most recent swing high, or above the original resistance if you want to play it safer. Set your take profit at the low where the move started. This is why the risk/reward on this setup is so good. You have a tight stop and a wide profit target. Even if you only win 1 out of 4 trades, you're still profitable. Often, after a big spike up and some consolidation, price tends to drop back and mirror the move it made up. It will often pause at the same levels it did on the way up. So, I recommend taking partial profits at each of these hesitation points. Another tip, on a higher time frame, look for bullish fair value gaps. These can also serve as potential take profit areas. And always remember to manage your risk. With this method, you've set your stop, your profit targets, and your entry, all based on logic, not emotion. Step 7. Manage your trade. Once price hits the fair value gap, it often immediately reverses and drops to your profit targets. When it hits the first take profit, sell 25% of your position. When it reaches the next, sell another 25%. Leave the rest to hit your final target for the biggest gains. And that's the beauty of this strategy. When it works big. If you want to go long, just do the opposite of everything I just explained. Good luck and happy trading.